Hey everyone, in today's video, I'm going to be talking about what changes I've been making in my $213,000 Wealthsimple stock portfolio over the last few weeks. We're going to also go through how my portfolio has been doing versus the broader markets, some news on some stocks that I own in this portfolio before kind of talking about what stocks I've been buying and what stocks I'm looking to buy in the week ahead. So we're just going to jump right into it. As I jump into it, be sure to give this video a thumbs up. It really does help with the video. As you can see, in the last 3 months, my portfolio has been getting destroyed, down about $13,000 in the Canadian side of the portfolio. So that's 10% there. On the US side, down 5,000 US dollars, so about 7% there. It has gotten a bit better in recent periods, down only 1% in the last week and pretty flat in the last week on the Canadian side, but generally still trending downwards. So lots of room for improvement, and we'll get through kind of what's been driving those losses. But before that, I just wanted to look at some of the overall markets here. You see here on the Canadian side, in the last month, the market's down 5%. In the last 6 months here, down 12%. So while in the last 3 months I haven't been doing well at all on the Canadian side, it's really been the whole Canadian economy in terms of valuations that have been going down. If I go over to the US side here, looking at the NASDAQ, because I have a bunch of NASDAQ companies that we're going to go through, in the last month alone, the NASDAQ's down almost 5%. So really bad performance from the NASDAQ, and we'll talk about why, but even in the last week, down about 2.5%. In terms of why, and I think this holds true both on the Canadian and the US side, there's a lot of reasons and things we can talk about, but I'd say the primary thing is interest rates. So interest rates on the 10-year treasuries are at 5%, actually crossed over 5% over the last few weeks, which just gives investors a really great opportunity to invest risk-free for 5%. It also plays with the valuations and net present values of free cash flows in terms of what needs to be modeled out and expected in a return on investment to make it worth it to invest in equities at these levels. So this is just very unfavorable given the opportunity cost to just put money in treasuries. And that opportunity cost keeps getting higher and higher as interest rates are getting higher and higher as well. Looking at my portfolio here and some of the stocks that I'm really down on, lots of it is tied to that interest rate dynamic. So lots of my REITs I'm down huge on. You see here Ally down 40% all time on it. Some other REITs here, Cap REIT down 22%. These are huge numbers for what you think are stable, large REIT companies, and REITs are real estate investment trusts. Some other companies that I'm down on as I go through my portfolio are my utilities and utility-like companies. You have Canadian Utilities here down 15%. This is a dividend king that's increased their dividend for over 50 years, currently trading over a 6% starting yield. So lots of these companies with high debt loads have just gotten crushed because of the increase of interest rates and increase in debt servicing costs. Continuing to go down here, other stocks that have gotten crushed, my telecom companies, so both Rogers, you see there, down 12%, as well as AT&T, which is on the US side, has gotten crushed as well. AT&T here actually had pretty good earnings. They jumped on earnings as we look at the past 1 month. You can see the jump. They're already starting to give some of that back with those interest rate outlook changes that we've been seeing. So that's been a tough headwind for the company as well, given how much debt they have. I'd say in addition to the 10-year treasuries being as high as they are, oil going up, all of the geopolitical risks in the world, starting to see some weakness in some areas on the consumer. All of these things was bundling together at the wrong time. I feel like with the market, when things are going well, interest rates going down, consumers healthy, and everything else, things just take off. But when things are going poorly, geopolitically, with oil, with interest rates in the US and around the world, it all kind of comes down like a house of cards. I feel like that's partially what we've started to experience here in the last few weeks. One other area of my portfolio that's been down pretty big is my food stocks. And lots of that's really tied to this narrative that Ozempic and Ozempic-like weight loss drugs are gaining a lot of steam. It's going to grow thousands of % in the decades to come, and lots of people will just have less of an appetite for sweets and addicting foods. We can look at some of the stocks I own here that's been affected. The one that comes to mind the most has been Coca-Cola. So Coca-Cola, we'll put a 3-month chart up, down 12% in the last 3 months. This is despite actually having really strong earnings in their last earnings report from just last week. So you can see the stock actually popped 2 or 3% from $54 to $56, but the stock's still down over 10% over the last 3 months, despite growing volumes, passing a lot of pricing, growing earnings per share, buying back shares, etc. Investors are still a bit wary because of that Ozempic note that went out and investor sentiment around that. The other one, and this stock probably got traded up a bit high, but still has come down significantly behind that news, has been McDonald's. So at $295, down about 15% from there, and really just boom, cratered over the last few weeks with the thinking that with people taking these drugs, if they go from what they are right now, which is ingested by a needle, to a pill or something like that, it may be a lot more common use. With time, it may get commoditized, a lot cheaper to take, and it would be no reason for consumers who have diet issues or have a sweet tooth, for lack of a better term, to be taking these products more to just limit how much they're craving. Products like Coca-Cola, products like McDonald's. You can see lots of other stocks, whether it's PepsiCo, Yum Brands, QSR, etc. All of these stocks kind of got a 10-15% haircut behind this view of the future. My personal opinion is it's a bit overdone. I don't think maybe a slight uptick in weight loss drugs are going to impact the outlook of these companies to a great degree, especially when you're talking about companies like McDonald's, which is phenomenal footprints around the world. They could always pivot to selling different kinds of products or serving different purposes for consumers. Population growth continues to expand. McDonald's is also a very global company, so Ozempic and these kinds of products may not be available all over the world, even if it does take off in the US like some analysts are anticipating. But that's one that has impacted my portfolio in a negative way over the last few weeks for sure. Another one I wanted to talk here is Microsoft. So I do own Microsoft in my portfolio, and it's kind of been holding flat, let's call it, over the last 2 or 3 months. You see about 2% down in the last 3 months, much better than the broader markets. But in the last year, you can see this one got hit really hard as interest rates were going up last year and has just kind of broken through that trend and that issue in the last year, up 40% behind their investment in OpenAI and just their broad business growth across the board. And just to talk about a couple things pertaining to Microsoft that's kind of come out here in the last few weeks. Number one is they finally closed their $70 billion acquisition of Activision Blizzard. This was a really big deal for them to just step change their gaming profile that's been kind of leaked internally as a really big focus of growth for the future. So that was a really big deal for them. It took them a couple of years to get through, and it's going to be really hard for these big tech companies to get acquisitions like this through in the future. So I consider this to be a big win. Didn't really dilute shareholders because they had tons of cash on hand. So now Microsoft shareholders are just getting a couple billion extra dollars a year from this cash instead of it sitting on the balance sheet from operating incomes due to Activision Blizzard, which is a profitable company to begin with. So they're going to own titles like Call of Duty, Diablo. I'm not a huge gamer, but I'm familiar with some of these brands. So I think that really just gives them a lot of options in how to drive synergies and win in gaming long term, which is really going to be a growing part of their business. And the second thing here is they reported really, really strong earnings. They had cloud revenues accelerate to almost 30% from, I believe, low 20s or whatnot. I may be mixing up my Microsoft and Google numbers a bit, but they definitely had the fastest acceleration within the cloud space versus Google versus AWS. They kind of tied that to lots of their rollout of AI-enabled tools, really growing cloud revenue and cloud usage. So that was really interesting to see the push into AI, where some say it's just a lot of sound bites and stuff like that, just turn into really strong business results on the cloud side. And they're really, really tying in AI into the business and their product suite more. It's not just jargon. So that was a nice takeaway. And they just had phenomenal earnings across the board. As I go down here, they grew 29%, so I got that right, faster than 22%. and 12% at AWS. So they're gaining a lot of share on cloud, which was great to see. The stock has a lot priced in, so I'm not surprised that it didn't really move up on the news to a great extent in the last week. I'm up pretty big on these shares, about 34%, also getting a slight dividend of about 1% there as well. Companies trading around 30 times earnings at these levels. Going over into some stocks that didn't perform well in the last few weeks of earnings. The first one, and not necessarily earnings, but just a really bad downgrade for Canada Goose. A lot of sentiment just on their China business doing extremely poorly. The consumer not really needing their products to the same extent anymore. In addition to that, lots of consumers bought during the pandemic and now don't need to buy another $2,000 coat, especially with how long these coats last. So you see they dropped 20% in the last month to their all-time low. If you look at the 5-year chart, and you can even go longer than that, I believe, depending on how long they've been public here. They just hit an all-time publicly traded low here at $15 a share. So trading for $1.6 billion for the entire company based off their outlook, the downgrades, and just the current macroeconomic position the company's in. So not a company that I've ever invested in, but if anyone's been waiting to jump in or try to get Canada Goose shares on the cheap, down 75% here over the last 5 years, really a lot of value destruction, which is a shame to see, especially after the nice little spike that they had from $30 into the 50s up to all the way almost 70 during 2020, 2021. They've given up all that back and more here. So that's been disappointing for those investors. Another stock that's been really disappointing is Tesla. So Tesla had terrible earnings. I've never owned the stock before, but it's just such a big company. I like to keep tabs on it. They missed deliveries, they missed revenue, they missed earnings. They had a 1,000 basis point hurt in their gross margins, which was just huge. Hard to even fathom that move. But they are investing a lot of capex and stuff like that, which may be impacting those margin numbers. They also seemed a bit timid to announce big investments in their Mexico gigafactory. I think Elon Musk mentioned some sound bites just on not wanting to overinvest in a time that they're not sure what's going to be happening with the economy. So some very conservative messaging there for a company that's typically not too conservative. So that was really interesting to see too. But it wasn't all bad for companies reporting. We have Netflix here up 16% on their earnings report. Phenomenal quarter, gained over 8 million subscribers, had some pricing growth in some markets as well, and spoke very highly of the ad model business, which they're going to be really trying to drive. They're increasing prices on a lot of their bundles as well. So they really hit the trifecta. They're proving out the ad business model, which is a huge opportunity revenue-wise for them still, given how low their ad revenue is versus how much attention they have from consumers. They're gaining subscribers naturally, and they're about to price to drive ARPUs as well. Really swinging on all cylinders. I know they probably had some cash flow help from the strike with Hollywood. That isn't necessarily sustainable, but still really strong numbers. Not surprised to see the stock pop like that. In terms of what I've been up to over the last little bit here, stocks that I've been buying will start on the US side. I've really been trying to take advantage of the dip in Coca-Cola. You see, I went all the way up to 200 shares here. I was probably closer to 150, 160 a few weeks back. Lowered my cost basis from the low 60s to the high 50s. And I just think this is a great dividend king stock that will find a way to continue to be relevant in the beverage space for decades to come. Whether it's through soda, water, protein shakes, whatever products that consumer appetite goes towards in whatever markets, I think Coca-Cola will be at the forefront. They have the distribution, they have the relationships, they have the consumer knowledge, they have the team that's created value on beverage brands. So I just think even if the company doesn't look like it does today, in 10 or 20 years, they'll find a way to continue to create value for shareholders with a rising population. They'll continue to increase their dividend year over year, which is currently paying a 3.3% yield. And this is a stock that I've always had a hard time getting into just because they've always traded at a really nice multiple, a pretty high valuation. So with that Ozempic news and just the general dip in some of these stocks with interest rates going up, I think it's a great opportunity for me personally to build out this position that I've always wanted to build out. So I feel pretty good about where it is now. The stock keeps going down. I wouldn't hesitate to get it up even more, but I'm happy with my 200 shares that I've built up into. The other stock on the American side is S&P Global. This company owns lots of indices around the world, like the S&P 500, Dow Jones, etc. So they get a little cut of those management fees. In addition to that, they also own one of the two biggest rating agencies on debt in the world with Moody's. That's a really high moat business. And they're expected to do about $13 per share this year, $14 next year, I believe. So the stock's trading at about 25-ish times earnings. It's definitely a rich multiple in this market, but for the type of business they have and the moat they have, I think it's a company that's going to continue to grow year in, year out, increase their dividend, lower their share count. So I really like the fundamentals of their business model. Trading down 7% in the last 1 month, down 13% in the last 3 months. These stocks very rarely go on sale. So I'm trying to take advantage of this sale that we're getting in the market over the last few months. And the third stock on the US side, similar in the financial sector here, it is Visa. Visa reported super strong earnings, in my opinion, grew revenues and earnings per share mid to high double digits, continued to say that their outlook, they have no reason to believe that's going to slow down in terms of their growth rate. They're buying back tons of stock, just announced another $25 billion share buyback, which is about 5% of the company here. This was one of my most bullish companies I was buying going into the year, right here at about $207. And I kind of slowed down on buying because it was going up into the 230s almost immediately, almost hit 250 a couple months ago. But with the earnings they just posted being better than I expected and the stock not really reacting in that same time period, I decided to add a couple more shares in this account here. This is one that if the stock continues to go down, I'd love to build out an even bigger position. They're expected to do $9 of earnings per share next year, so trading at about 25 times earnings. That's a valuation for a very quality, high-moat company like this that I can get behind. The biggest risk, in my opinion, is regulatory risk in the US and the EU. I think from a fundamental business standpoint, more people will be moving from cash to card. They'll continue to think of more ways from a use case perspective to use their network, whether that's business-to-business payments, rent payments, other types of payments. So I think they should be able to grow in other ways. It's really just the regulation that I'm concerned about for this stock. Going over to the Canadian side of my portfolio, one interesting stock was Allied Properties. I didn't really buy much more of it this week, but the stock's down to almost or just under $16 per share. They reported earnings this week as well, and I actually thought they were pretty good. They did 55 cents in funds from operation, so still on pace to do between $2 and $2.25 in funds from operation, which has them trading at about 7 times earnings here. So you're getting 7 times earnings for this REIT, which is predominantly an office REIT. That's why it's trading so cheap. But they have an 11% dividend yield, and they even mentioned on their call they're not looking at if they're going to cut their dividend. They're having conversations on how much they're going to increase their dividend by at the end of the year, which just kind of speaks to the growth and the confidence they have in their existing business and also their pipeline that they're currently building out for 2024. A couple other stocks that I've bought into in this account. RioCan, another REIT with REITs just getting hammered. I finally added RioCan in this portfolio. It wasn't a big buy, just 15 shares, nibbling in here, already down 2%, of course. So you see here down in the last week, in the last 3 months, down pretty big, almost 20%. They're still planning on doing $1.80 of funds from operations. So this one's trading at 9 times earnings, more of a retail REIT than a office REIT. So a bit less volatile, a bit more defensive since lots of their tenants are grocery chains and stuff like that. Nonetheless, still trading under 10 times earnings, paying me over a 6.4% dividend yield. So I thought it was a good valuation to dip my toes into this one here. But I'm being very careful with how much I nibble on these REITs just because of how exposed they are to interest rates. That's why I only kind of went in 15 shares for now, and we'll see how everything pans out over the next few weeks and month. And the last stock I started buying more aggressively in the last few weeks was Rogers. Rogers here down another 1.5% 8% in the last day. But in the last month and 3 months, we're down significantly, almost 15% in the last 3 months. They're expected to do $5.20 of earnings per share next year. So you're getting Rogers at under a 10 times future earnings multiple, despite the fact that they have very sticky services, tons of recurring revenue streams like on their wireless division and their internet division, and they own flagship media assets like the Toronto Blue Jays and portions of the Toronto Maple Leafs, Toronto Raptors, which will ensure they have audiences for years and decades to come. Whether it's on cable, on streaming, or whatnot, they own lots of the underlying assets that attracts attention and eyeballs in the Canadian economy. So I think 10 times earnings is a great value for this company that's been around for a long time, getting a 4% dividend starting yield on this one as well, and currently trading at a market cap of $27 billion. One of the reasons this one has traded down over the last little bit, you can see lots of investors were initially excited about synergies from their takeover of Shaw Communications out west, but it seems like that excitement's gotten diminished, probably primarily with the amount of debt that they took on to fund the acquisition. But I believe with their business lines and how profitable some of their businesses are, call it even their cable business currently, their wireless internet business, stuff like that, they'll be able to aggressively pay off that debt in the next 12 to 24 months. They're yielding about 10% free cash flow, and they're only paying out about a 4% dividend yield. So they have about 6% of their market cap coming in as cash on an annual basis. That's over $1 billion, close to $1.5 billion a year, just by doing some napkin math, that I think they should be able to use and hopefully primarily use that to start paying off debt and getting their balance sheet in a better spot post acquisition. So those are some of the stocks that I've been buying and I'm continuing to evaluate buying in the few weeks ahead. In addition to that, I am looking at a couple cash position options to continue building out as interest rates do get to very high levels. So one of them is high interest savings ETF cash. The other one is HSave, which I currently have some money in as well. That kind of just accumulates high interest over time, just to make sure that I'm not parking too much money in low yielding options. And this one right here, I have about 120 shares. It goes up very, very slightly, as you can see in the last 3 months, but better than not having your money making you anything, in my opinion. And also with how volatile the market is and just the global economy and geopolitics right now, I like having a nice little chunk on the sideline. So I kind of dipped into this over the last few weeks as the market continued to trend down, but I'm going to also be trying to build up my cash position in the coming weeks as well. Hope you guys enjoyed this review. Hope my portfolio does start turning around, and this just serves in the long run as a great opportunity to dollar cost average at lower prices. But I appreciate you guys sticking with me to the end. If you guys made it all the way to the end, let me know in the comments. Appreciate the support. Be sure to like this video and subscribe to the channel for more, and I'll see you guys in the next one. Thanks.